Well, the Federal Reserve is continuing to poop on the expectation that markets should get 3 full rate cuts, including the one that we just got. And now we're pricing in just 1.5 rate cuts. Why? Well, because past data is pretty good, and most members at the Fed are telling us we's good. We don't need to rush down. But there are some calling for emergency cuts, and it's not just Myron, or at least calling for more rapid cuts. We've got to talk about that and sort of balance all of this out with companies still laying off. Bosch cutting 13,000 jobs, though most of that is happening in Germany. The economy is still globally connected, and it makes you wonder what's going on, because you've also got CarMax plummeting off a cliff, Starbucks announcing $1 billion in restructuring, store closings, and about 900 corporate layoffs. That's on top of the 1,100 corporate layoffs they just did. And it's starting to make people wonder, is the economic data good because of a big old pull forward earlier this year, or is this a continuation of hopefully a soft landing? Because when CarMax is down 23% on top of already being on a massive downtrend, I mean, look at this. This is literally like the meme where it's like, and it's done. Like, this is like a rug pull on CarMax is what this looks like. It's terrible. So how do we reconcile all of this? What's being said in that earnings call? What are they talking about? And what is CarMax doing with consumers right now? Is there potentially a red flag there? Well, we got to touch on all of that. I do want to make a quick note that in the course member live stream this morning, we killed it, okay? We called this double bottom and said, go bullish. It's why I was late to the public open live stream this morning. And you've got folks in the chat who are saying things that are very nice. So I appreciate y'all. So some of you saying things like, hey, the course pays for itself 10x. What you said this morning on the bottom, nailed it. My calls are printing. Here, Wayne says, so worth it. Course is on point today in conjunction with what he said, where the market seemed to be done with the big dump this morning. I bought calls and they're still printing. Thanks for saying that, Wayne. That was really nice of you. So really cool. I mean, it was a great day for the Meet Kevin Alpha report. And keep in mind, that's something we've been doing over the last few days is we set up sort of the expectations for the day. But then this morning, I walked everyone through this drop. And my expectation was the worst we were going to go was negative 100 basis points. And when we pulled through that, I said, volume, watch volumes. We rejected VWAP. And you can watch this. This is recorded. Like, I'm not just like rewriting history here. You can watch me say this. I go, this is a very weak rejective VWAP. I bet you we will have another stab up and we will be breaking straight through to the upside. And sure enough, we formed a double bottom and it was straight up. We did all of that technical analysis live and we even bought the dip. So we're down in this area. So if you're not part of the Meet Kevin membership yet, check it out. Remember, you get all the top 10 stocks to buy, the private live streams, the alpha report when I send trade alerts, the everything. Pay once, you get lifetime access. With all that out of the way, let's get into this data. So look, we have a list of Fed members who spoke this morning. Mitt tells us that inflation is still too high and the labor market is still in balance. That is probably the worst thing the Fed could say right now, because obviously the labor market is weakening, but they're choosing to look at signals that are, how should I put it, less desirable, because they're looking at just broad unemployment rates and unemployment claims. That's what markets are doing right now. Markets are saying, hey, but Kevin, unemployment claims this morning came in fine, and continuing claims were fine. This is true, but this is also some of the most noisy data we could look at. And this is where the concern is that the Fed is going to make a massive policy mistake. Initial claims this morning, 218 versus 233, expected 232 on the prior. Continuing claims were down 6K, although the prior was revised up 8K. So, this is noisy data. I mean, 2 weeks ago, we had horrible unemployment claims, and then the state of Texas, who's basically a Trump shill, is like, oh, that was only because of fraud. Oh, okay, one time out of nowhere, all of a sudden that 1 week, oh yeah, that was only high because of fraud. Whatever. So the data that people are paying attention to, specifically the Fed, a lot of the Fed members, I worry is going to prove that the Fed will end up being too late. And the biggest thing that I pay attention to regularly are updates to that 27 weeks long-term unemployed level, because it says that these people have been unemployed so long that they're not even being counted as unemployed anymore. If you added these people to the long-term unemployed, or to the current unemployment rate, the current unemployment rate would be substantially higher. In addition to that, we've actually seen the labor force participation rate come down. And if the labor force participation rate stabilizes back up and we get higher layoffs, we're going to be in a very rapid 5 to 6% unemployment rate almost overnight. And the Fed is going to be blind to it. This is the labor force participation rate. You can see that we did have a downtrend post the financial crisis. But look at what's recently happened here post-COVID. You had this big push up in the labor force participation rate. And since 2025, the end of 24, beginning of 25, you've seen this drop. I think this drop is a little easier to see if we go to the quarterly data, just because it's going to smooth this out a little more. See this drop right here? If this drop normalizes back up to where we were over here, we're going to see the unemployment rate skyrocket. And this is what, in my opinion, the Fed is blind to right now. Again, you had Schmid this morning tell you, hey, the labor market is in balance. Inflation is still too high. Woolsby says, hey, whoa, we got to be careful about front-loading cuts because we don't want inflation to take off and end up proving to be more persistent. And we're optimistic. We're on a golden path here. Oh, that's great. Now the Fed is talking about a golden path. Like everything's gilded, I guess. Everything's fine. But labor market data shows, per Goolsby, moderate cooling. But Daly clarifies this. And she's like, look, we don't really see a recession right now. Stagflation doesn't seem like it's around the corner, but we don't really want any more softening in the labor market. We just want it to stop. We had literally like 4 speeches this morning. It was insane. So I'm giving you the TLDR here. Bowman says tariffs will have a one-time price impact, but it's appropriate to shift to focus on jobs versus inflation because we're within the range, the flexible inflation range of 2%. And the labor market might be more fragile than expected. And therefore, we should justify more cuts now. But she's in the minority. See, Bowman and Myron, they're in the minority of emergency cuts or at least rapid cuts now, not going to zero, but get rapidly off of that restrictive level so you stop causing more damage to the labor market. I think they're both right. I think Bowman and Myron are right that we should be lower. We should be at like maybe a 2 or 2.5% rate for a Fed funds rate instead of a 4 where we sit now, so we can hope to minimize some more of that damage to the labor market. Because remember what you're seeing at CarMax, and this is really important. So go back to, dude, the freaking Q's calls keep printing. That's what we called that double bottom lies in the course member live stream this morning. I'm so happy about that. I'm so happy about, well, I mean, I bought the dip too, but I'm so happy that we were able to pull that off in the Meet Kevin membership this morning, live. I'm like, watch it go straight up from here. And it did on a double bottom. This is great. So congrats to all of those of you in the Meet Kevin membership. But anyway, understand what CarMax said this morning. CarMax said that in their analyst earnings call, we looked at sort of the live transcript of it because the earnings call was going on this morning while we were in the Meet Kevin membership. And CarMax was saying, hey guys, listen, yeah, we know we're getting into more subprime loans, but we're trying to remain competitive here, guys. Okay, hold on a second. That's really bad, okay? That's really bad. I mean, yesterday we did a video talking about Tricolor and, the other auto group, these bankruptcies coming in the autos. That's not good, but it could be because, people are getting deported and the companies could have just sucked, right? But now CarMax is telling you guys, look, we're going to cut SG&A to get margins up. Don't worry, it's not going to affect our advertising, but we're not as competitive as we would like to be. So we've got some repositioning to work to try to get better. And then, one of the analysts is like, so you're going to do more shitty loans, like more subprime stuff? Like, isn't that bad going into a potential recession? They're like, well, you see. So it's like, it's not good. And so the CarMax situation today begs the question, is the data that we're getting, this GDP data that came in so hot this morning, is it saying that the economy is strong, or is it saying that the economy has been strong because artificial intelligence, almost certainly because of artificial intelligence. Deutsche Bank this morning suggested we would have been in a recession in Q1 had it not been for the AI buildouts. Okay, great. But and then you look at capital good orders, capital good orders coming up 0.6% today versus the 0 expected. And that's on top of the 0.8, which was slightly revised down, but it's on top of the 0.8 we got last month. That's really good capital good orders numbers. Really good. So companies are investing in infrastructure. But is CarMax potentially the sort of leading indicator that now we're getting so much stress amongst the consumer that is bubbling up? You start getting the subprime lenders go bankrupt. You start getting Starbucks, the Chipotles, the regular kind of consumer stocks start having stress and start bubbling up and start laying off more people, which just leads to lower sales. The cycle begins. The thing that's booming again, that AI build out, but is it also possible we had a really big pull forward of people blowing money on stuff? So the idea here is that, especially with CarMax, which they reference as well, maybe people were so worried about the impact of tariffs, they bought a car in Q1 or in Q2 during the pause. They're like, let's get ahead of tariffs. Let's buy a car now. They buy a car. And then what ends up happening? Nobody's buying a car in Q3 because, well, technically they're Q2. Their Q2 is funny. Their Q2 ends August 31st. So it's June, July, August. So you get this lull because there is such a pull forward. You're going to get that, by the way, with Tesla as well. Like, I think Tesla's going to have a record delivery number here in the third quarter for Tesla. With deliveries that are coming out, I think next week we'll get those. Next week or the week after that, we'll get delivery numbers, first part of October here. And those numbers will show how many deliveries we were able to get with an expiring $7,500 coupon code. It is literally like, Kevin saying, hey, the Meet Kevin membership price goes up tomorrow night, which that is what it's scheduled for. You go to meetkevin.com and you can see that. But that's extreme. I mean, like, we raised the price of the Meet Kevin membership over time because we think we keep adding more value, especially a day like today. We just freaking killed it with the calls. But and buying the dip at like the perfect time. But you go to Tesla, this is a $7,500 coupon code that's expired. That's insane. Now, Tesla will probably have to drop their prices to be competitive in Q4 and Q1. But I don't think they're going to drop their prices $7,500. The credit will go away. Tesla will drop their prices, $2,000 or $3,000. Or they'll give, you can't really buy down rates anymore because you're already buying them down to 0. So you will see price drops on Tesla in Q4, and there is a potential negative sentiment that'll come with that. Like, you'll get price drops in Q4, only part of what the credit goes away. And then, everybody will bitch about the pull forward to Q3 with Tesla because people will be like, oh my gosh, like, nobody needs to buy a car in Q4. That's a Tesla because everybody bought it in Q3. That's kind of exactly why I think we're going to lose the 414 line. And I've got exposure to Tesla stock. So, I'm saying it as somebody who's got exposure. Q4 and Q1 will probably suck, but Q3 should be really nice. But I don't think that will be enough, right? Okay, so now, reconcile this at the same time as you've got this weakness of the consumer. You have a Federal Reserve that's like, look, things are good, labor market data, it's fine, guys. It's fine. Okay, so great, but what happens when all of a sudden we end up getting an increase in layoffs, like what you're seeing announced at Starbucks, except it's more ubiquitous, right? What happens is we will go back to zero interest rate policies because the Federal Reserve is basically sitting on a button. It's basically like, hey, as soon as we see those layoffs spike and the unemployment rate skyrockets, zero interest rate policy. Who's going to win when that happens? Lenders, real estate companies, house hack, knock on wood. But the economy is going to suffer. And people think, well, I mean, if we go to zero interest rate policy, won't that be stimulative? Not enough. You don't stimulate until the Federal Reserve actually turns the money printer on. And so not a single member of the Federal Reserve is prepared for it. I kid you not. There is not a single member of the Federal Reserve that is prepared for it. Why do I know this? Because Myron is the most dovish out of all these people. And Myron says, even though I'm more sanguine on growth than others at the Fed, and I think that shelter inflation will come down, and the longer we stay restrictive, the greater the risk, I don't think the labor market is about to fall off of a cliff. Okay? So, in other words, even the most dovish of doves is like, labor market's not going to fall off a cliff. Fine. Maybe that's true. Maybe the Atlanta Fed real GDP is right. And, the economy is booming at these levels. That's fine. Of course it's going to boom at these levels when we haven't seen the unemployment yet. But if for some reason we get that spike in unemployment, the GDP will come down as a lagging indicator because spending will drop, earnings will plummet, and then you'll see GDP come down. And then it'll get revised down too. So none of the Fed members, even the most dovish, are ready for it. So that's this balance that we're running into. Now, that actually creates some interesting, potential investments for gold or the dollar. While we're higher for longer, the dollar does well. So the dollar went up today because we're only pricing in 1.57 cuts. Gold is flat, but realistically should be up because there's a greater chance, in my opinion, of the Fed making a policy mistake. And gold loves being a safe haven in the event of a policy mistake. Now, you've even got people like Jeffrey Gondlock who are saying you should have up to a 25% allocation in your portfolio to gold. That's insane. That's like such a massive exposure, but that's because he views stocks as expensive and gold as a great hedge. Maybe it's not insane. You go into a recession. Once you're in a recession, gold usually doesn't do that well. Gold usually does well with the fear of a recession potentially coming. It's very interesting. But this breaks down for you what happened this morning with data, this hot data that shot yields up, unpricing Fed rate cuts, and then you get more neutrality from the Fed. A Fed that's basically like this, hey guys, really what you have is you have the Fed, like here's the range of the Fed funds rate, right? And all of them are dancing around the middle. They're like, we might need to vacillate down a little bit. Oh, we might need to vacillate up a little bit. They're kind of here. And I'm like, bro, if the labor market falls, y'all aren't going to be vacillating around here. You're going to be like, oh, crap. Yeah, rates are going to come down so dang fast. And so yields going up today increases the risk of a policy mistake. Now, why? And this is just education for you. Why in the Meet Kevin membership this morning did I think markets were going to go up after the sell-off this morning? Why did I think that? I thought it because we are not going to fully price in a recession today. The data today, like unpricing, 40 bips or 30 bips of interest rate pricing for the year is not enough to get the market to sustainably sell off. It's not that bad of news. If anything, it's decent news, and the Fed's just being neutral. So yeah, the market is responding to the Fed's neutrality here, but who cares? Who cares? They didn't justify the Qs being down 130 basis points. I literally wrote this morning in our Meet Kevin membership, I think the Qs at most today deserve to be down 100 basis points because the news isn't that bad. And then we watched it live. We saw it go to 130. I called it. I said, this is extended. We called the double bottom, and it was up from there. Because it doesn't deserve on this, what we got today, to be down that dramatically. This is just weenie babies waking up in the morning hitting the sell button. That's all that was. And then we saw in this double dip that sell volume was actually falling. Mind you, if you join the Me Kevin Alpha reports, you could literally watch me say that recorded this morning. Oh, volume, lower volume on the downside here. It's not going to last. We're going back up. It's fan. MeetKevin.com. You gotta be part of the MeetKevin membership. We got what is it on a regular, on a live, I think we've got 1,500 of y'all watching. And then, when you include replays, it's 3,000 or 4,000 of y'all in the Meet Kevin membership. So thank you for those of you who are there. But yeah, so this breaks down exactly what went on today. And it's useful to know for the future. So I'm a big fan of that. Somebody says, too damn late, Jerome. Oh, yeah. Yeah, exactly. Sean Moon says, gold up, bad job, gold up, rate cut, gold up, recession. So it's not true that only hot inflation hurts gold, in my opinion, because I actually think hot inflation helps gold because people see it as a hedge, right? And they see it as a wealth protector during inflationary time. But what I do think you have wrong is I do think in a recession, gold typically falls. Gold rises going into a recession because people use it as a fear product. But once people are in a recession, it also gets sold. So it's an interesting duality on gold there. But yeah, no, I mean, at the moment, sure. Yeah, it certainly makes sense that gold's interesting. Somebody, Russ Moment says, buy McDonald's. McDonald's does typically do well. The thing about McDonald's is it loses less in a recession. Historically, I've studied this. Historically, it loses less in a recession. But it still doesn't mean it's a moon, right, in a recession. Anyway.
Knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.